rates potentially going below 7% by the end of the week. I should have said end of the day. Man, that was quick. So the important thing to talk about is now what? Where do we go from here? Remember, folks, with mortgage rates today, we actually don't need the Fed to cut the federal funds rate. We don't need that in order for mortgage rates to come in. It would not be out of the world of possibilities for mortgage rates to come down 50 basis points, 50, so 0.5%, and the Fed not cut rates. Now, how can that be? Well, it's something we have talked about for a long time that is actually occurring right now. We are seeing the spread, which was historically wide at over 3%, or what they would call 300 basis points. It is now working itself back to normal. Normal we can call 180. I think it currently resides at about let's call it 260. So it is possible for rates to go from 6.99 to 6.5 without a rate cut. Now, how can that happen? Well, a couple of ways. One, banks, financial institutions would need to have faith that the Fed's not going higher. Well, I think you can take that to the bank. I think the Fed has made it clear that they are done. There's been a couple of Fed presidents that have made threats of going higher, but as we have talked about many times, those are just threats. They are not going higher. So if banks, lending institutions have faith that they are at the terminal rate, next, you are seeing financial institutions who do lending struggle, right? It has been depression level activity. Well, guess what unlocks activity? Lower rates. So what is possible now that we have the Fed kind of locked in at terminal rate, it is possible that lending institutions will lean in and we could see rates go from sub 7 to probably mid 6s. Call it 6.5 to 6.6. So that's rates. Now let's talk housing. Let's start with active inventory. We have been on a trend pretty much all year, pretty much since November actually, where active listings were going up. They were going up, at different rates, but they were going up nonetheless. And as I have said repeatedly, that is a good thing. We need a slower housing market, okay? So we got what we wanted. Well, something else we've talked about for 2 years now, the U.S. consumer is predictable. And it is my educated assumption that now that we are below 7, and if we trend below 7 to, say, the mid 6s, we're going to find out marginal demand. Marginal demand is those folks that are on the sidelines that have been waiting for rates to come down. It is my current guess that within the next 3 or 4 weeks, we are actually going to see active inventory roll over, like actually go lower week on week. I was fortunate enough to speak with Mike from Altos Research, and we had this discussion. He thinks it is far more likely that the rate of change will become narrower but won't roll over. So I appreciate Mike Simonson a bunch. He's probably right, but my opinion stands. From all my conversations, there are so many buyers that are like, I'll wait for rates to come down. And again, why would the marginal demand happen? Well, it's been my experience that consumers like a deal. Consumers like a deal. And 2.5 years ago, when rates went from 3 to 6, everybody was locked into 3, not a deal. Today, we have home shoppers who are locked in at 8, who remember 8, who remember 7.5. So now they are looking at something with a 6 on it as a deal. And it is that anchoring recency bias that I think will flood. I don't know if flood is the right word, but we will see activity increase. And the good news is we won't have to wait long. It will be by the end of June. So where are we? We're right at call it the middle of May. So by the end of June, we will know if I am right or wrong. So that's where we are with rates. That's where we are with active inventory. It is going to be very, very interesting. I got some more good news for you. If you are part of my school community, you obviously know we had our first conversation yesterday with Dion and Matt. We have the one coming up with Anna on Tuesday. But the uneducated economist, yes, folks, Simon, the gentleman with the dice, he and I will be speaking 9 a.m. Sunday. And if you are in my school community, you can go to the calendar and you could be a part of that discussion. You could set up and give me some questions to ask Simon. So if you are in the school community, you now have another valuable session to be a part of. And this is where we're going. As far as the school community goes, I want to be clear. Once we hit 100 students, we are going to start to keep some content only on school, right? We will keep 1 video, 2 videos a week only on school. As we are building to 100, we will continue to publish everything on YouTube. But yes, Simon was a huge hit at the Vegas event. He wanted to get together and have another conversation and talk to the One Rental at a Time community. So you will see Simon, 9 a.m. Zoom link is already there. You don't have to attend, obviously, but I thought it would be another treat for the school members. We have had some earnings come out, kind of a mixed board. We had Cisco Systems. Remember, we've talked about Cisco for pretty much every quarter. To me, Cisco Systems is an indication of what is going on in rest of world, right? What is going on in Europe, in Asia, and things of that nature. Well, they did beat top and bottom, but folks, revenue dropped 13%. 13%. They did raise guidance, so maybe they're feeling better about the future. But yes, they had revenue drop 13%. Public sector was particularly weak. I thought that was interesting. We have some software companies out there that are very much public sector heavy. I think it's not unfair to say that Palantir is very, very much, I think if you look at their revenue mix, public sector oriented, I think. So again, it's just interesting that Cisco called out a particularly weak public sector, which would be federal, state, local governments, probably universities as well. We got news from Under Armour. Under Armour is taking on an 18-month restructuring. Read that as layoffs. They are going to be cutting costs and focusing on what they do well. They lowered guidance. U.S. sales down 10%, and they expect it to get worse. That's not good. That's not good. Walmart was kind of a sneaky report. They beat top and beat bottom, right? Remember Walmart, we talked about early on, like what is going on with the bottom portion of their customer base. What we should have talked about was Walmart getting new customers. Yes, folks, Walmart called out high-income shoppers increasingly shopping at Walmart. So I don't know this for sure, but maybe they're trading down from Target to Walmart, or maybe it's Whole Foods to Walmart. I don't know what the right trade down is, but it was pretty interesting that Walmart called out high-income shoppers as how they beat top line and bottom line. John Deere is always one of those companies I look at for what's going on in investments, and they cut full year outlook. So you're definitely seeing the impact of higher rates, less projects, less building, things of that nature. So again, Deere cut full year guidance. Wayfair, I don't know if you've shopped on Wayfair, but Wayfair is making a big pivot. I don't know if you saw this. They are opening their first large format store. Looks like it's going to be 150,000 square feet. They're again going physical, not only online. It is going to be a mega store in Wilmette, Illinois. Wilmette, Illinois. Illinois. I don't know. Is there an S when you say that, Illinois? I don't know. You tell me. So again, it's very interesting. We may be seeing more and more online folks go physical, which I think is an interesting pivot. Kind of some inflation breakdown that I saw. Inflation, food away from home was up 4%, 4.1. Energy up 2.6. Vehicle insurance, man, I got hit by this myself. I couldn't believe my car got hit. It's crazy expensive. Vehicle insurance up 22.6% in the latest reading. Average credit card balances are $6,218. That is up 8.5% year on year. We are clearly charging more. Also, 90-day delinquency is the highest since 2010. And the average rate on credit cards, folks, get ready, 20.66%. Yes, over 20%. Folks, if you are carrying $6,218 on your credit cards, go look up Dave Ramsey. You've got to get that paid off. You will be getting yourself a 20% return. That is pretty wild. And then finally, we did get a reading from another Fed President, John Williams. The overall trend looks reasonably good. Yes, folks, I think the Fed is taking a little bit of a victory lap, that the numbers looked a little better this month. He says there is no need to tighten. He is definitely going on the offensive, saying we are not going higher. We could be here a while, but we are not going higher. He does see unemployment ticking up ever so slightly to 4% this year. So that's where he sees inflation going. And this was interesting. We got to pay attention to this. They are not going to wait for inflation to hit 2%. They will need to have confidence that inflation is trending to 2% before they cut. So again, they are basically telling us we are now have the dual mandate. Remember, Jerome Powell, the Fed pivot happened in front of the microphone at the last Fed meeting. He said something like, we are now focused on our dual mandate. So watch the labor market, watch weekly unemployment claims, watch the monthly numbers. It is pretty clear. So folks, thank you for everything you do. Hopefully you are a part of school or will be a part of school soon. I'm looking to bring a lot of unique content and unique opportunities. As the community grows, we will all, start sharing and networking and doing all of those things. So again, folks, hope to see you inside school. I hope you appreciate, actually, we have a 6 p.m. call tonight. If you're in school, we have a 6 p.m. call tonight, just open discussion. We have 2 sessions on Sunday, an 8 and 9, and then we have Anna on Tuesday. So we got a lot of stuff already scheduled. More to come. Take care. Later.